Welcome to our presentation, The Use of Guideline Public Firms to Determine Private Firm Enterprise Value. This presentation is divided into two parts, and each part is divided into an A section and a B section. Part 1, we look at the theory, and in Part 2, we look at how that theory is put into practice. A quantitative approach to adjusting public firm multiples, presented by Dr. Stan Feldman.
Welcome to today's presentation. My name is Stan Feldman. I'm Chief Valuation Officer of Axiom Valuation Solutions. We are a global financial service firm which specializes in the valuation of private firms, securities issued by these private firms, which include common stock, preferred stock, derivatives of all sorts, fixed income instruments, as well as intangible assets, which would include patents and trademarks. Today we are addressing the issue of using guideline public companies as valuation metrics for determining the fair market enterprise value, if you will, of private firms. Now, the use of guideline information is one of the chief metrics that's used by most appraisers. It's used by investment bankers, M&A professionals, and it is an important metric in determining the fair market value of a firm. Now, the major problem that emerges is that many of these guideline companies that are used are not perfectly matched to the private firms, though there's clearly, by the definition of guideline, we mean firms that are similar in a variety of characteristics to the private firm that's to be valued. Now, today, this presentation is divided into two parts. Part 1 is more theory, and Part 2 is practice, namely some examples. But the takeaways, I think, that you'll get will be that in most instances, the use of guideline information to determine the fair value or the fair market value of a private firm tends to be incorrectly applied, and the result being that the conclusion of value is often wrong. And today what we're going to review is how not to make these mistakes. That is, namely, how to use guideline information in an appropriate way. How is guideline public company information used in valuation of a private firm? What the appraiser will typically do is calculate what are termed multiples. Multiples are enterprise value to revenue, or enterprise value to EBITDA, or equity value to net income. And remember, these guideline companies are public, so all this information is available and to be used in the context of valuing a private firm. Just as background, enterprise value is defined as equity value, the market value of equity, plus the market value of debt, plus the value or the market value of other long-term liabilities. And typically what happens when somebody develops an enterprise value, they subtract out the debt or the long-term liabilities to get to equity value. So that's the traditional way this is done. So today we're going to cover a number of topics related to the use of multiples in valuation. And the first is, why the multiple? Like, why is that a magic metric? The second item we'll cover is why the direct use of guideline public company multiples to value a private firm will in general inflate the value of the private firm in general. There there are exceptions to this. The third thing we will cover is how do you make adjustments to public company multiples so they're more applicable to the valuation of private firms. Why do we use guideline public company multiples and valuation? What's the theory behind this? The theory relates to the law of one price. If we have two assets that are identical in every respect, trading in two different markets, the prices in each market should be the same for both of these assets. If that's not the case, there's what's termed an arbitrage opportunity, namely the higher priced asset gets sold using common stock market parlance would be sold short. And that would reduce the price, or tend to reduce the price. And then the proceeds of that short sale would be then used to buy the exact asset in another market, and that would boost the price. And at some point, arbitrage will equilibrate the prices in the two markets. So this means that if a public company and a private company are exactly the same in every respect, when I say every respect, I mean same industry, same product, same business model, same size. Everything's exactly the same, but one's public, one's private. They should be selling for the same price. If the revenue multiple, if the public company guideline firm is selling at 2 times revenue, then the private firm should be valued at 2 times revenue. Now, again, and this assumes that there's no adjustments for the fact that the private company and the shares of the private company are illiquid. So we're just keeping that to the side for the moment. But assume no discounts for liquidity. The two firms should be selling for the same price.